Hello, everyone, and welcome to our lecture series on managerial accounting. And I'm your instructor, Jamal. Hi there. Today, we are starting a brand new chapter, which is performance management in decentralized organization. So, the crux is that the managers in large organizations they have to delegate some decisions to those who are at lower level in organization. So basically, this lecture explains how responsibility accounting management, which is a new term, uh, that managers are responsible only for those actions in which they have control. So also this chapter is related on ROI, which is a return on investment, residual income, and operating performance measures. And the last topic would be the balance scorecard and how they are used to control decentralized organizations. So, this chapter is not about centralized organizations. So, we're talking about decentralized organizations. So, what is decentralized organization? So, in decentralized organization, the decision making authority are given to the lower level managers so that they can have autonomy in decision making as well. So what are the benefits and the disadvantages? So the biggest disadvantages of the decentralization is that the lower managers may make decisions without seeing a big picture, since they are dealing with day-to-day customers or routine customers. So they are not seeing the bigger picture, which means they are not capable of forecasting the future, right? So in decentralization, the biggest picture is that the lower level managers they have narrow focus. And second drawback is that they may lack coordination among autonomous managers. It means if I have the power to decide my own situation or my own department situation, then I do not coordinate with the other managers because it's my autonomy, it's my power. So it's like it's my house and you are not allowed to come in. So that is the biggest problem. The second biggest problem with the decentralization. And then the lower managers objectives may not be those of the organizations. So since we already discussed about agency problem, which is that managers they may try to increase their own salaries in their own compensations. So since managers are employed by the direct board of directors or the directors, and the company belongs to the shareholders, so the problem with the lower level managers is that they always after increasing their own pockets, so this may create a problem between shareholder and manager and the company as well, because company belongs to sorry, shareholders, and shareholders want to increase their own wealth while the managers work for them to increase the shareholders wealth. But instead, by increasing the value of the company, they are increasing their own pockets. So this may be a third biggest disadvantage. And the fourth one is it may be difficult to spread innovative ideas in the organization. And we will learn in our coming slides that some uh, projects or investments are profitable, but since their salaries or their compensation are linked with some other kinds of measures, so they may just drop this option because it may not increase their own salaries. So this fourth step of the drawback we will discuss in our coming slides. So let's move forward. So since the decentralized organization, it does not confine decision making authority to a few top executive, Rather, the decision-making authority is spread throughout the organization. So the advantages are the number first, that is that it enables top management to concentrate on strategies, so higher level decision makings and coordinating activities, which means that the top management will focus on the future of the organization, that where they want to see the organization after 5 years or after 3 years, after 10 years, or what new businesses they will be investing in, or what new product lines they will be introducing the market, and what kind of other businesses they want to just get rid of or want to divest, or divestiture, we can say that. And the next one is it acknowledges sorry it acknowledges that the lower level managers, they have more detailed information uh, about the local condition that enables them to make better operational decisions, right? So it's because they deal with the customers directly, so they know the real problem, not the symptoms. So that was two. The third one is that it enables lower level managers to quickly respond to customers, like whatever the customer want, or its needs, they can quickly satisfy, or if any situation occurs which is new, so they have the authority to resolve that issue or resolve that problem at the same spot, uh, towards the customers, and in that way customer can better satisfy their needs as well. So number fourth is that it provides lower level managers with the decision making experience, so they will be needing when promoted to higher level position, so at that way they have gained the experience of decision making. And rather you post the higher level management position to outside, why not you go to the to offer post or advertisement of job to your internal employees. So by doing this, you basically enables them that we're gonna hire you because we have trained you, and since hiring a new employees takes time, training and cost as well, so you can also save those costs and training as well. The last one is that it often increases motivation, resulting in increased job satisfaction. When you see that, okay, the company is giving us so much authorities and we are trained to do the decision making and participation as well, so it increase their job satisfaction as well, and also job retention, which is very important for the organization, so that the key personnel, they don't leave the organization, right? So same way, when they got the job satisfaction, they have improved performance as well. Okay, now let's talk about the concept of responsibility center. So we already discussed about responsibility accounting system, which basically link the lower level managers, a decision making authority, with accountability for the outcomes of those actions or those decisions. So the term responsibility center is used for any part of the organization whose managers have control over and is accountable for the cost, profit, and investments. So the three primary types of responsibility centers are cost centers, profit centers, and investment centers. So what is cost center? So in the cost center, manager of a cost center has control over the cost, but not over the revenues or investment as well. So here we have service department, and under service department, what are those departments who just provide services and they are not responsible for revenue or investment? Number one is accounting. We have general administration department, or legal department, right? And the HR. So these are the departments who are referred to as cost center. So in that case, they are not responsible for revenue and investments. right? So we call them cost centers. The next one is profit center, in which the managers of a profit center has control over both cost and revenue, but no control over investment funds. So what are those? So companies cafeteria, right? That belong to profit center. So in that case, in the profit center, it belongs to revenues and cost as well. So the next responsibility center is investment center, in which the manager of an investment center has control over cost, revenue, and investment in operating assets or operating opportunities. So the investment managers are often evaluated using return on investment or residual income. We will learn in our coming slides what are these. So the example of the investment center is corporate headquarters. So in corporate headquarters is managers. They are also responsible for cost, revenues, and investment as well.